Well, hello, welcome everybody. Thank you for joining us for our last installation of the year, I should say, for Healthy Finances for Nurses. As Casey said, my name is Nicole Warschauer and I head up community over at Trusted Health. If you're not familiar, I always like to say that Trusted Health is the place for the modern nurse. We do place travel nurses in all 50 states across the US. We also have an incredible wealth of resources for you, the nurse, the modern nurse. Whether it's podcasts or blog posts or events like this, we really do want to create a community that supports you holistically. So that's what we're here for. And you know what, without further ado, I'm going to kick it right over to Lynn Frair. She is our hostess with the mostest, and she's going to talk to you all about finances tonight.
Hello, everybody. I'm so happy to see so many people registered. I think there were over 400. Is everybody seeing where it says admit and all these various things on my scene? I can't tell what everybody is
Only
seeing
you
on
see
your
that.
end.
Only you
Okay,
see it. No worries.
perfect. All right. All right. So here are some of the things that we hope to talk to. Well, we in fact will talk about why I think investing is a necessity for financial success, the number one financial mistakes nurses make, the top factor preventing nurses from beginning to invest, and how to actually start investing in the next 30 days. And we'll talk a little bit about who I am, why I started doing this. I'm Lynn Frair. So I'm a hospice RN. I am the founder of fihealthcare.com, and I became what I call work optional at the age of 39 because I began investing. I was a financial coach specifically for nurses, and now I just do larger scale events specifically for nurses to empower them about their finances. A little fun fact is that I'm good with money, but I'm bad with a lot of other things. I'm good with nursing, good with money, terrible at cooking, terrible at a lot of things, but I love talking about finances and nursing. So I married a chef. Was very strategic. So you're in the right place if you are curious about investing, but you don't know where to start. You feel overwhelmed, you feel confused, intimidated. You want more freedom and flexibility. You want to pursue passion projects. Maybe you want to spend more time with your family, but you feel like things are just too much right now. And I think right now is a good example of why people are wanting more time and flexibility and understanding of their finances. So I have to do a little legal disclaimer. I'm a completely self-taught finance geek nurse. I make no claims to be a financial advisor. And in fact, that's why they wanted me. I don't sell products. This talk is for nurses, by nurses. All information is for educational purposes and not intended as individual investment advice or product endorsement. So I wanted to make sure you guys all knew who exactly I am. Okay, so this is Lynn. This is me when I was 12. I had crimped hair. You can't see because it's cropped out. I had stonewashed jeans in that picture. And I had just won a national essay contest for writing about a barber chair that I was sitting in. And at that point, they gave me savings bonds. And that was the point my 12-year-old brain realized that something could be worth more in the future than it was worth in the present. And that's sort of what got my mind thinking about investing. Just the idea of the accumulation over time. And I thought to myself, I have age on my side, like you do when you're 12. So I started investing my babysitting money. I was always fascinated by this. So it continued to grow. I eventually, about a decade later, met my husband, who's a chef. I think he felt bad for me because I was such a bad cook, but he liked me. Luckily, we got married. We had a couple. We're doing well. We were accumulating. I was a nurse. He was working as a chef, and then we got a little surprise. So this is me with my dad. My dad might be in the audience. He didn't know this was going to be on there. So I was surprised to find out I had a brain tumor. And so I had to have the brain tumor removed. I had to have a craniotomy and I had to have a metal plate placed in my head to learn how to walk again, not because I was weak, but because it was like I was walking on a rocky ship all the time. So I was a pretty new nurse. I was an ICU nurse at the time. And over the course of those 2 years, I had to reduce my working And I also lost a lot of money to financial needs because of medical expenses. And so everything that I had built up since I was 12 was wiped out. So I had to rebuild again from my late 20s. But we did, and we did well. And we had a couple of kids, and we formed this new life. They're my little kiddos, they're a little older now. My husband. And in 2018, we decided we wanted a little bit more flexibility. We wanted to be able to travel more. We wanted to work on our house. We had some issues with our house. And so I said to my employer, hey, I'd like to work as much or as little as I want from wherever I want, whenever I want. What do you think? And they said no. So I said, okay, well, thank you so much for 13 and a half years here. I'm going to take some time. And I gave them 5 months notice. And so we took all of 2019 off to travel. We took 6 trips as a family together. We worked on our house. People said, you'll never regret it. Life is short. And I didn't really know we would all be in this situation right now. But that is how we proceeded. And the reason for that is because my passive income from investing overtook my nursing wages. So that work became optional. So this is what I do now. So I that job that I said that I wanted more flexibility. About a year later, they had a more flexible role for me. So I do work per diem, and it's a fantastic fit for me. I also speak about finance for nurses. Fascinatingly, I'm still fascinated by this. The Wall Street Journal wants to talk to me about investing, and Market Watch and various media outlets. I think they're sort of fascinated why a nurse would sort of quietly invest all these years and do as well as the market does, as well as people who are stockbrokers, in fact, when you take out the fees. And the concepts are really quite simple. I think people want to make it seem very confusing, befuddling, so that people feel disempowered, but I actually think they're quite simple. So that's why I do what I do. The other thing that I do, one of the issues that we ran into was, what do we do about healthcare if we leave traditional employment? And so I spoke with hundreds of people actually, and thousands of pieces of information. And I aggregated the information for myself and then went to Washington, D.C. to ask, who has this information? I would like to give you all I've compiled. And nobody had it yet. So they said, well, why don't you make it? So I did. So I created the website, fihealthcare.com. And so I create and maintain that website. So that's another passion project that I do. So now it's time for a poll. Are you able to take over? Do you take over screen share? Okay. What is your biggest fear about investing? The options are, for those who can't see, or if you're on mobile, that I'll make the wrong decision, that I'll lose money. I'm embarrassed to start the process because I don't even know the terms, meaning like the verbiage. Yes, there is the fear that they'll lose money is number one, and that they'll make the wrong decision is the second one. And so I've asked my colleagues here, my co-facilitators, to let me know if I start spouting verbiage, because I've been studying this so long, sometimes I forget that I'm saying an acronym. So they'll intervene if needed. But yeah, number one answer is that they'll lose money. Okay, perfect. Do you want me to reduce this? Yeah.
You can, Lynn. No one else can see it.
Oh, okay.
Magic.
Perfect. Thank you.
Sure.
So the answers that you gave are exactly as I expected, and we're going to talk about all of those. So what do I mean when I say investing? I'm not going to talk about real estate investing. What I'm going to talk about is investment into the stock market or into bonds, financial markets. And so I'm going to tell you really briefly the difference between a bond and a stock. And this is going to be really 101 level introduction. If we have more advanced questions, people can ask that in the chat or afterwards, but I wanted to start with a basic introduction so that people don't feel overwhelmed that we're talking over their heads. That's not what I want at all. I want a basic introduction, and then we can do more advanced things later. So when I talk about investing, you ideally have a certain set of income and then you have a certain set of expenses. And ideally, there's a gap between that. Not in all cases, but in some. And that with that gap between what you earn and what you spend, you can invest. And in investing, we often hear about stocks and bonds. And stocks are really buying small portions of companies. And bonds are really more loans to different entities. So the general idea is that a bond is lower interest rate return on average, but a little bit less volatile. And a stock is on average higher, I shouldn't say interest rate, higher return for a stock, but a lot more volatile. And so if folks are willing to take on more risk in general, they'll have more stocks in their portfolio. So that's what I mean when I'm talking about investing. But before you start, one of the biggest things to do is to assess your debt and take a look at what you already owe and the percentages that you're paying on those debts. Because the analogy that I use is you don't want to remodel your kitchen and get it all beautiful when you have your garage on fire, because then the fire is going to take down your kitchen. So do you guys get that analogy? Can I see some? Okay, great. So if you have interest rate debt that's higher, say 7% or higher, then it's important to attack that debt before you really look a whole lot about investing. And Trusted Health has some wonderful resources about attacking debt. My friend Nasima, who's here, she also did a speech, she's waving, about debt. And Trusted Health has great resources on that subject. We're not going to go into that, but I do want to acknowledge that. So why should you consider investing? One of the reasons I think is because of inflation. So inflation over the years, so is the reason why a loaf of bread is no longer a penny. It goes up about 1 to 3% a year. So that means it erodes your buying power over time. So there is a risk actually to not investing too. So there's a risk in everything we do in life. There's just different types of risk. So I think that's one of the big reasons. And the other big reasons is if you're able to accumulate a financial runway, then you're able to reach different areas of your potential that you couldn't if you were held down working paycheck to paycheck for debt. So that's another huge reason. So we're going to talk about myths. Investing is dangerous. And I think that in some ways, like we talked about, everything has a risk. There are natural fluctuations in investing. I'm a big fan of buying and holding and not trying to trade. So you'll hear people talk about their hot stock tips. If anybody tells you a hot stock tip, that's a yellow or maybe red flag, because we really don't know the future of what the future is going to hold. And those types of investing is more trading, and that is, I would consider that more high risk. So I'm a fan of buying and holding an investment. Another myth is that it's too complicated. And I think just like anything, we can make it as simple or we can make it as complicated as we want. What I want is for you guys to start getting a basic understanding so that even if you outsource to, say, a financial planner or financial advisor, that you know a little bit about it. So just like we would outsource maybe getting our oil changed on our car, if you know the basics about how frequently oil changes need to happen, and then you have somebody telling you you need an oil change after 2 months, having that knowledge of basics of investing, even if you outsource, is so, so powerful. So I'm a big fan that even if you outsource, understanding the basics so that you know a little bit about what you're talking about with anybody you outsource to. Another myth is that it's too late to start. And so I think that time is certainly a huge, huge element. But for folks, it's really something that can have beneficial value within 5 or 10 years. And we're going to see a little chart a little bit later. But I think that there's also risk to not investing. And so you have to weigh what is the biggest risk to you personally. And the fourth myth is people think that they don't have enough money or they don't make enough money. But a lot of the times you can just do very, very small amounts. So here's compound interest. So this is an example of two different nurses. One started at 25. We didn't have any that started at 12, but I had to restart again at 28, 29 really. So who started and they saved $100 a month at the age of 25. And then compared to another nurse who started $100 a month at the age of 35. And you can see the difference that made. This is actually a pretty conservative amount, the 5% annual compound interest. If you have a heavier stock portfolio, it's closer to about 8 or 9% on average. And again, some years it's up 40% and some years it's down 40%, but on average. So this is fairly conservative, but you can see the big difference. It's a matter of essentially double because of 10 years. Okay, I think this is a good point to stop for questions from folks.
All right, guys. So you can just actually pop your questions into the chat and I will read them out loud and I'll do my best. So we can give you just a minute to throw any questions in there. All right, here we go. We have one from Stephanie. She says, I plan to buy and hold stocks. I'm having trouble figuring out which online broker to choose. I know the basics about their fees, but I don't feel like I know enough to determine which fee structure will be most beneficial to me, considering I plan to buy and hold stocks and not trade constantly.
Okay, such a great question. So I'm part of what they call the FI community, the Financial Independence Retire Early community, and we're a bunch of financial geeks. And what I can tell you is that the most favored brokerages are Vanguard and Fidelity within the FIRE community. But that's not to say that every product in there or every person in there that you can always trust in. But those are good companies in general to start with. My absolute favorite is Vanguard. Just because of their model. It's more, I guess, owner based. Like they have their heart in the right place. Again, not to say that every single person, I can't speak for the entire organization, but that's a good, decent place to start. And then as far as options of what to put inside those funds, there's a book that I really like called The Simple Path to Wealth by J.L. Collins. Nasima's nodding. And that is a really good basic principle about sort of what to look for in terms of allocation. Because I'm not a financial advisor, I can't give individual investment advice, but that is a really great start.
Awesome.
Does that answer the question?
It answered for me. We can double check. I am writing this down as we go too, by the way. So
yeah, I see you guys taking notes. That's good.
Nicole, you're scribbling too as we're hosting.
Yeah, good. That's good.
So this is from Leslie. What platform do you use to invest? Or do you have a financial advisor? Do you use a financial advisor?
So I don't use a financial advisor. I'm my own. I do my own investing, but the platform that I use. So I have through my employer, I have Fidelity, and they have some decent fund choices. So I'm happy with that. And then separately, I have Vanguard. So the two that I recommend are truly who I use. I do my own investing. And later on in the talk, I'm going to talk to you about what you should look for when you look for an advisor, the questions you should ask them, and when you should look at their face to see their responses. So I'm going to talk specifically about what I would look for if I were hiring somebody. But I tried to hire 3 financial advisors throughout the years, and they all said, wow, how did you do that? And so I was like, okay, I'm good. I'm going to just do this myself. And I'm not kidding. They really did. And this was like my early 20s. And so from there forth, I just decided to self-manage.
That's awesome.
Yeah.
Deanne asked, I want index funds. Where do I find them?
So index funds are a product that are you can buy them through any brokerage. So if you consider a brokerage like a store, so you've got like Safeway, Albertsons, they sell those products inside the store. So you can go there and you see what selections they have. And a lot of those stores, brokerages like Vanguard and Fidelity, will have slightly different products in there. So you can buy them from any of the brokerages, which I call investment stores.
Okay, awesome. Nasima asked, are you saying you shouldn't invest if you have debt? I like M1 as well.
So I think what you need to do M1. So M1 is something that I don't know personally about, but I hear really good things about M1. So I'm not saying that you shouldn't invest if you have debt. So if you have, a lot of people have home debt, student loan debt. I think what you should look at is what are the interest rates of those to see, and also what is your risk tolerance. I think you should take stock of what you have and see if it makes sense. If you have interest rate debt that's in the 20% and stocks on average bring in 7 to 9%, it would be financially a little bit suboptimal to be paying somebody else 20% and then earning 9%. It's more financially beneficial in most cases to pay that debt down. So I think it really is individual. It depends on the percentage. I mean, the interest rate is one of the biggest factors for me.
That makes sense. I think this might be the last question for this round.
Okay.
Are you making your own index funds? Are you buying or are you buying Vanguard index funds?
I don't make my own. Yeah. I keep it simple as possible. And one of the things that I'm looking at right now is, so what I was buying was, if you guys have heard of the S&P 500, it stands for the Standard and Poor's 500, which is the top 500 stocks that are US based. And what I was doing was buying an index fund that has a low expense ratio. So one of the things we'll talk about later is expense ratios. But now I'm really personally more interested in socially responsible index funds. So that's what I'm starting to shift toward, is not just a US based index fund or a global index fund, which is a sampler basically of a lot of the biggest companies. I'm looking at more, which are the ones that hold the values closest to the ones that I prefer, even if they have a slightly higher expense ratio.
That's awesome.
Yeah.
I think we probably should move on. We have so many questions, by the way. So
okay, that's so good. Oh my gosh, I'm so excited. You guys are excited about this because I have to calm down because I get too excited. I don't want to scare people away. This is not normal. I've kept this to myself till I was like 39, quietly investing because nurses don't, So thank you. All right.
Just a note, I will try to go back and ask these questions that we did not make on this round, by the way.
Okay.
So
yeah, great. So what is the number one investing mistake nurses make? Can we get it in chat? Do people have ideas? This is from working with nurses as a financial coach. So now I just do larger scale events. I don't do individual coaching, but do we have any feedback in chat?
Yes. Not investing is the number one response right now.
Yeah.
Or they spend money on stupid stuff.
Yeah.
Or spending more than we make.
Mm-hmm.
Those are all great answers.
Yeah. Those are all awesome answers. What I've seen is that people wait because they're afraid to lose money. And so they are afraid to even start, even small, because they're afraid that they'll lose money. And you will lose money. That's what stocks do. I kind of think of it as in the short term. In the short term, you will lose money occasionally. I think of it as like a breathing rhythm. So you inhale and exhale, and there's a natural fluctuation of the stocks. And in April, actually, the Wall Street Journal asked me, are you freaking out? So the coronavirus, it was really big in our area. You guys might have seen when it first broke, it happened to be in our area. And they said, are you, because the stocks were plummeting. And I said, well, I'm not freaking out about the stock market because that's what it does. I am worried about this virus. I don't know what's going to happen there, but this is what it does. It's a natural cycle. And if you need money really soon, you wouldn't want to stick it in the stock market. But if you can wait many, many, many years and you're willing to handle that risk of the fluctuation and you can emotionally tolerate it, that's why you get the good returns. It takes a lot of emotional strength, though. So, what's the hardest thing about getting started with investing? Are we going to ask in chat or?
Yep, you can throw it into chat.
We have lack of confidence, which I can speak to myself as well.
Yeah. Well, any others, feel free to let me know, Casey. But what I want to say about confidence is, now I don't want you all to get overconfident and say, Lynn got me all excited, and so now I'm going to just sell everything and put it all on black. That's not what I'm talking about. But so men with investing tend to be overconfident in their abilities in investing. They think they can, on average, this isn't true for all men, but statistically, they believe that they most often can predict outcomes. They can pick the hot stock. Women tend to, on average, be underconfident investors. And guess which one is easier to fix in my experience is a little bit of underconfidence. And that comes with knowledge, that comes from education, just like attending events like this. And so what I found is one of the hardest things is fear of losing a bit of money in the short term. And how do you get over that fear? Is by incrementally learning, just starting small, just doing one thing. So now we get to talk about how to start in 30 days. And these are the steps that I recommend. So take stock of what you already have invested. So that means assessing your current debt first. What are the interest rates of those debts? What are the fees? If you have investments, what do you have there? Like what's in there? What's in there? So most of you guys will have employer sponsored plans like 401ks, 403bs, 401as, 457bs. Those are all versions of employer plans. And just look to see, what do you have in there? What type do you have? Google it. What does 457b mean? And see what you have in there. You're just exploring. Then I want you to call your brokerage and say, can you tell me all the fees I have? I want to know all the fees, because you're just finding out what you have. You have to take stock of where you already are. And then if you don't already know, figure out if you have an employee match and how much that is and how close to it you are, because that is a benefit that you are entitled to as part of your compensation package. It is, people say it's free money. I mean, not really free, but it is something that if you contribute to, you're matched at a certain percent. So it's a guaranteed return unless you have very, very, very high interest rate debt. In most cases, this is going to make sense for you to go up to your employee match, at least. Some people will tell me, I'm maxing out my employee plan. And what they mean is they're maxing out their match, but maxing out their whole plan is a federally set number. And I think it's $19,500 per year. So that is more likely maxing out, and it's quite a good size max out per person, so per working adult. So to find out your employee match, that takes maybe 30 minutes, usually calling your HR. Okay, so we have step 1, calling your brokerage or calling your investment place, figuring out what you have. Step 2, finding out your employee match, calling them if you need to. And then step 3, setting up your automatic retirement contributions to automatically come out. And if you feel like you're not able to increase it at all, increase it when you get a cost of living increase, or a lot of them will set up automatic yearly bumps where they'll bump you up every year by 1%. So you want to incrementally find ways. You aren't going to go from zero to a millionaire right away. These are incremental steps that you do that over time make this huge, huge difference. So then what do? You find a tribe of nurses who talk about money. We were like, when I met Nasima, we were just like unicorns. And now there are, right? She's nodding. I wish I could see all of you guys out there. There's a lot of you. Find a tribe of people who actually are comfortable talking about this. Like money is, it's not just money, it's part of our life. We're exchanging our time and our energy to get money. And so this isn't why we entered the profession, but if we become knowledgeable about it, we can do so many great things, care for our family, take time. So much good can come from this. A couple of the resources I like is called the Nurses on Fire podcast. And it is specifically for nurses about money. She's got on, I know I've talked about Nasima like, I think this is 6 times so far, because there's not a lot of nurses who talk about money, but it's growing. And she has a podcast specifically about it. She's got a financial advisor who is now talking about environmentally sustainable funds on there. Just really, really great resources. Also, she has a community, financially intentional Facebook community. So I encourage you to just start doing one thing, just one thing. Find people who are talking about it. Find people who are answering questions, moving through this. So people like to know, I'm posting my 2 favorite questions people like to ask me is, what do I do when the markets tumble? And so I go back. So when people start pulling everything out, when the stock market dips, because it dips like it does, like breathing, it always does. And people pull out because they're acting emotionally. So I go back, I consider what was my plan when things weren't like this. If I sell right now, then I'm buying high and selling low, right? That's the opposite of what we want. So I consider my plan. Am I acting from a place of emotion? Probably. Is it all over the headlines in the news? Then that's emotional. Emotions and investing don't work well together at all. If I'm feeling a sudden urge to do something, that's again emotional. It is something that I'm probably going to regret. So instead of selling things, what I might do, because sometimes we feel like we need to take some sort of action. In nursing, we see this a lot where families want to help a loved one by taking some sort of action, even if it's not that helpful. And so sometimes we give them things to do because they just want to feel like they have something in their control. And the same is true for investing. Instead of selling, I consider maybe I'll buy something small if I feel that urge. So this is what I personally do when the markets start tumbling. And I am the only person that I know that stuck in through the 2008, 2009 and didn't change my plan at all. And I'm grateful for that. And I think that we're heading into a very volatile time. And so if we can stick with our plan, keep our emotions out of it, don't look in some ways. I don't mean be ignorant, but I mean come up with a plan when you're in a good state of mind and realize that it's like a normal cycle of breathing. Most markets recover within 2 years and almost all within 4. So just keep those emotions out of it if you can. So this is what before you hire an advisor, this is what I would ask them. Are you a fiduciary in all aspects of everything you do? Everything. So a fiduciary is somebody who will act in your best interest. And some of the laws around this have been weakened. And so the requirement is that people have to do things that are reasonable for you, but aren't necessarily the best. So ask them if they're a fiduciary in all aspects of everything they do. Then ask them, can you put it in writing? And then watch their face. Yeah. I see some of your guys' faces. Watch their face when you ask them to put it in writing because they may not expect it. And you want to see what they'll do. Because if they are truly a fiduciary, meaning that they want to act in your best interest in all aspects of they are happy to put it in writing. They are proud of this. They want people to know they're a fiduciary. So that is what I would do with every financial advisor or financial planner you want to consider. And then if they start asking about whole life insurance right away, that is I put yellow flag, that's a red flag, because whole life insurance, uh, there are some benefits. I think in general, for folks who have like $10 million, there's some tax benefits. The reality is the people who are most excited about whole life insurance are the people who sell whole life insurance. And they usually get, if you look it up, if you just Google what are the commissions for whole life insurance, often your entire first year's premiums go toward commissions. It's thousands of dollars. And so you think, is that in my best interest? Um, mm, so that's a red flag for me. Or the other one that I didn't put on here is if somebody tells you they have a hot stock tip, that's a red flag. We don't know the future. Warren Buffett admits he doesn't know the future. He is one of the best pickers that there is. And so those are really the things that you want to keep an eye out for. Um, so we can go back to questions now. We can return to the ones that were there and
Um,
have new.
I think we answered a few of them, so I'm trying to be selective since we have so many.
Sure.
I do want you to answer one because I think it's just a term that I want to make sure everyone's familiar with.
Yeah.
One of the nurses asked, "What is an index fund?"
Oh, yes. Okay. So an index is a sampler platter of company stocks. And so there's a lot of different indexes. The one that I use the most is the S&P 500, as we were talking about the Standard and Poor's. It's a company. It's the top 500, to overly simplify, biggest companies. And because they're the biggest companies in the US, they're also, most of them are international. And so an index fund is like a sampler of those largest companies. There is some of them are a sampler of like 3,700 companies. And so it takes small pieces of each of those, combines them all together. So you don't have to try to stock pick. You are taking a sample of the entire market. And because there's not a lot of active management, the expense ratio tends to be lower. So when you call Fidelity or when you call your brokerage and you ask about fees, ask them for every single fee in your plan. Ask them, is there anything else? And they may say things like expense ratio, which is another term for a fee. Some expense ratios for index funds are as low as, some of them are doing sort of these marketing things where they're essentially free. But some of them are as low as 0.04%. Some of them are as high as 2%, and 2% is actually pretty huge. So if you see an expense ratio that says 2 point something or 1 point something, what you want to look for is 0.0 something or 0.1 something or 0.2 something. That ends up being a huge difference over time. And that ends up looking like the graph of the nurse A and nurse B if your investments are eaten away by fees. And I think what makes me crazy is about seeing, some nurses where all they would have done is if they would have looked at those expenses, they could have had, $50,000 more in their retirement or 100 just by little tiny tweaks. And so that's why I talk about this.
Awesome. Thank you so much.
Yeah.
Moving on to this section, Brooke asked, do you suggest maxing out the federally allowed limit or just doing the employee match and investing the rest elsewhere?
So that's going to be case by case and kind of in the realm of financial advisor territory. But I'll tell you a few things that I think about is, for most people, getting the match is going to be your best immediate return. And then, the match is in like a 401k. So that'll be before taxes. Then once folks meet that match, it can often be prudent to go to a Roth IRA, which stands for, it's named after somebody, I think, individual retirement account. and it's after tax, and maxing that out. I think that's 6,000 a year that you can do. Nusima, yeah. Yeah, she says yeah. And then for most people going back then, maxing out their pre-tax bucket. So does that make sense? So your 401k pre-tax, filling up to the employee match, going over to the Roth IRA, maxing that out, then going back to the full federal maximum if you can. And I think that sits at 19,500 per year per person from memory. And I think you have a catch-up contribution if you're over the age of 50 or 55, where you can add even more.
Okay, awesome. Let me see. Sorry, I lost my spot. What is your opinion on buying certificate of deposits? How do you set them up so that interest compounds? Not all ladders compound, it seems like. I'm not quite sure. I'm not as familiar with this question.
So certificate of deposits called CDs. I'm not as familiar with CDs, to be honest. And so I'll tell you what I do know, though, is that it seems like it keeps the money for a certain period of time with a certain fixed interest rate. And so some people will ladder them. They'll buy a chunk and then they will mature after a time and then the next year. So they'll have 5 years. So this certificate of deposit will mature in 5 years. Then in a year, they'll buy another CD that matures in 5 years. So that they mature at different times. So that's what I know of as laddering. But I'm not sure that I know how to answer your question in detail because I'm not as familiar. So I always like to let folks know when I'm not as familiar, and that's a topic that I don't know about the compounding of the CDs. So that's the extent of my knowledge on that.
Okay, cool. I just want to address this next question, then we'll probably need to move on and try to come back. I just want to clarify this for someone. Are the
Sure.
term expense ratios and dollar cost averaging the same?
Oh my gosh, this is why I'm not normal. I get like so excited about these kind of questions. So I love that you know the word dollar cost average. And I see some people like laughing at me. Okay. In a good way, in a loving way, I'm sure. So dollar cost averaging, I'm a huge fan of. That just means you are every paycheck or every period of time, you are putting in a certain fixed amount of money. And what happens is that when the market goes up, then you're buying fewer shares. When the market goes down, then you're buying more shares. And over time, it's a nice, smooth way to get a sample of what's going on in the market. You don't have to try to time the market because statistically that doesn't work. It just doesn't. They've done so many studies on it. So dollar cost averaging is that principle where every month you have a certain amount that you put in, regardless of what the market's doing. And over time, that will average out to what the market conditions are. So you don't have to worry about timing the market. So I'm a big fan of dollar cost averaging. Expense ratios are something different. Expense ratios are when you buy something, it's the fee that's charged for the thing. So index funds, as we talked about, is sort of a sampling of the whole market. When they take that sample, they'll charge you a little fee for it. And hopefully a little fee. Some charge a lot of fee, but they'll charge a fee for that. So expense ratio, I think they call it that. So people don't realize that it's a fee. Because if they called it expense fee, then I think more people would be aware of what they were actually doing. That's one of the reasons I do this, is because I think this information should be more transparent. And yeah, great question. See, I told you I'm just like really nerdy about this kind of stuff. Dollar cost averaging.
We probably need to move on to the next section. You have one more, right, Lynn?
We're in good shape. Yeah, we have the little surprise.
Oh, is that all that we have left?
Mm-hmm.
Oh,
Yeah.
great. Sorry, I looked at mine.
Yeah.
That's totally my fault, guys. Yeah.
No, that's good. So we can do more questions or we can go to the little surprise.
Let's go ahead and do some more questions. So talking about these expense ratios, Molly asked, so what do we do when we learn the fees and how do we tweak our employer plan?
Yeah. So most employer plans will have several options. You should in a lot of cases, you'll be able to see what those fees are. If you see that a lot of your options have pretty high fees, and what you can do is you can simply Google what are the average fees for these certain types of funds. And if you see that they look big, then you can talk to your employer and say, wow, these are the options. What really frustrates me is there's a lot of 403Bs that have really high fees. 403Bs are often with healthcare workers and teachers, and it's really a shame. So if you go in there and you may not know what is normal, what is expected, is this okay? That's why you're starting the process of figuring out what it is. This is going to be worth an investment of your time because it could have the potential of being tens of thousands of dollars, and your future self is going to thank you for trying to figure this out. And so yeah, you have the power to talk to your employer too about fees. And I'm going to talk to my employer about getting socially responsible index funds in our I think hardly anybody talks to them about this, you know? So I really believe, and maybe I'm overly optimistic, I really believe that we have the power to change this because so few people pay any attention to it.
Yep. And actually, that was a previous question I wanted to follow up on. How do you find those socially responsible index funds?
Yeah. Well, Nasima's got great content on her Nurses on Fire podcast, and they're just starting a whole section about it. So I'm looking forward to listening to that. I'm trying to think of the best resources for socially responsible indexes, and her podcast is the first that comes to mind. There is also there is an assessment tool that I can put probably for you guys for follow up when you guys send out the email of how to look, and there's a rating scale for socially responsible funds, so we can put that in the follow up items for folks to be able to peruse. But yeah, I think that's what I hope is that's going to be right now. The expense ratios of those tend to be a little bit higher, but they're still quite reasonable for some of them. I found some pretty good ones. And my hope is that enough of us start investing in environmental, social governance funds that the fees will come down over time because it's market demand demands that. So I'm excited about that prospect.
Okay, awesome. Let me see. I want to cover these about the plans through your employer. Amanda asked, what if you aren't on the employer plan? She has a Roth IRA.
Yeah. So, well, you can set up your own retirement account separate from an employer, which it sounds like you have. The other thing that's a possibility for nurses is to start a side business, and then you can start to do your own retirement account separately. So that's another possibility.
Okay, awesome. Danielle asked, if your employer doesn't match, does it make more sense to continue contributing to the employer sponsored 401k, or does it make more sense to move on to the Roth IRA?
That's a great question. It'll depend on the individual situation, of course. Definitely not. Yeah, it'll depend. But what I would look at is what is inside your 401k, your pre-tax. What are those fees like? And also, do you need a pre-tax benefit? Are you looking to have tax deferred benefit, or are you not? So pre-tax, where that's a benefit, is if you think that where a Roth makes sense, which is the after tax, if you're making less money than you think you might in the future. So it's kind of a matter of what do you think will happen in the future? Is because it's after tax, it's good to pay the taxes now on average if you think that you're going to have a higher income in the future. The other thing is that what do we think taxes are going to do in the future? That's the other variable. And so if you think that taxes are going to be higher in the future, then you might think about the Roth more often. What I tell people is if you're not really sure, the great thing is you don't have to do either or. You can do a little of both. And that is effectively one way of getting the average. And so a lot of people will say, should I do a Roth? Should I do a 401k? I think that you should do both. You should split whatever you're considering and do both because there's pluses and minuses to both. And we don't know the future.
Okay, awesome. I'm actually, interested in this as well. I think this has been asked a couple of times. Leslie asked, I'm really interested in knowing how to use your passive income. Do you have it deposited into your checking? I guess, how do you use your passive income to pay your bills?
Yeah. So that's such a great question. So my employer and a lot of nursing employers who you work for a public district hospital, you have access to a 457B. That's one of those ones that I mentioned earlier. 457B retirement accounts can be withdrawn at any age without the 10% penalty. So usually when you take money from your and consult your tax advisor, I have to say that. But usually when you take money from your 401k or your pre-tax retirement account, you have to pay ordinary income taxes and a 10% early withdrawal penalty. So in every case that in my case, I'll talk about my case, that is not the case for 457Bs. So that's where we drew our passive income from, is from the 457B because it's after tax, or it's you pay ordinary income taxes, but not the 10% penalty.
Okay,
Does that make sense? Yeah.
So I think people have a couple questions. Amanda was going back. She was the one who asked about if she only has a Roth IRA, and you mentioned, if she can start her own business and set up her own retirement account. She actually does have an LLC and she has a business. So someone else had also asked, like, how do you go about setting up an retirement account if you have a business? Do you know much about that?
That's something that I don't know. And I think that would be a great financial advisor type question, because I don't know that much about that. I do know that that's a popular avenue. I know that a lot of folks will have a self-directed IRA, self-directed individual retirement account, and you really can direct how that's invested. But the process for doing that, I think, may be different based on your geographic location. And so I don't have the best answer for that.
Okay. So another nurse asked, if we feel like we can invest, can you give us an example on where you recommend we start? Like, what percentage of total income would you recommend one investing?
Yeah. So it's going to depend. It's going to depend on the individual, of course, but there's almost no downside to investing more if you can reasonably. But yeah, there's just, if you're looking for a goal, it's going to depend on your age, your goals for retirement. And but I think a good general start is, first of all, I'm going to recommend another book that I think would be helpful. It's called Save 10. And so I'm going to give away the answer right now. Is 10% is a very good start. If you can manage to do that, I recommend that book, which is written by Sarah Catherine Phillips Gutierrez. And I think it's a fantastic resource for looking at the percentages. She runs a company called Aptus Financial, which I am very fond of, and she does great work there. But I think that is a great place to start, is saving 10%. If you're able to do that, if you're not able to do that yet, start where you can, build up to that, because every incremental improvement ends up making a difference. I think some people think, well, I can't save 10%, so I won't save anything. Well, if you can save 1% and grow, you just start where you are.
Okay.
And awesome. More is better. I mean, if you're able to reasonably. This is a weird time for people. This is a weird time for nurses. Some people are making a lot of money. Some people are laid off. And so it really is going to depend on where you are, what you think you can reasonably do. and still have a good quality of life. I mean, we still go to Starbucks a lot. We have a Starbucks line item in our budget. Not my proudest moment, but I think that you have to decide what's important to you, what can you let go reasonably, and go from there.
Thank you for coming, and hopefully we'll see you at our next event soon. Good night, everyone.
Thank you, guys.
Bye, everyone. Have a great night.